Welcome to this explainer. Look, we're skipping the usual agenda today because we've got to jump straight into a seriously high-stakes corporate survival story. We're talking about Atomera and the massive, ticking clock they are racing against in the first quarter of 2026.
Okay, let's dive right into this because we are looking at a classic, absolute pressure cooker dilemma in the tech world. Is Atomera holding a golden ticket that's going to completely revolutionize the entire semiconductor industry, or, are they just holding a ticking clock while their cash reserves slowly drain away?
Now, the juxtaposition of where this company sits today is just staggering. Seriously. On one hand, you've got these massive technological promises, breakthroughs in advanced transistors, a brand newly expanded partnership with an industry heavyweight like Synopsys. But then, on the other hand, for the entire first quarter of 2026, Atomera brought in a grand total of $11,000 in revenue. Literally, 11 grand. In the semiconductor world, that is practically a rounding error. And that tiny slice of revenue, it was made up entirely of wafer delivery fees to a large integrated device manufacturer. Wild, right?
So, let's get into Act 1, the technological promise. The whole core of their business model rests on this thing called MST, which stands for Mears Silicon Technology. Basically, it's a proprietary, ultra-thin engineered silicon layer. Now, without getting completely bogged down in the deep physics here, just think of it like a microscopic supercharger for modern microchips. It is specifically designed to give transistor performance a massive boost at incredibly small geometries. And look, if this actually works at a commercial scale, it's exactly the kind of efficiency upgrade that next-gen CPU and AI applications are absolutely begging for right now.
And honestly, we've got to give credit where it's due. They actually have some serious traction in the lab. They've currently got active gate-all-around demonstrations happening with 2 leading customers. And CEO Scott Bibeau even pointed out that these customers are physically sending them wafers to process, which, in this industry, is a huge sign of commitment. On top of that, their expanded Synopsys partnership is really pushing the boundaries in gallium nitride, or GaN, device modeling. In fact, the recent RF GaN on silicon data was so mind-blowing that one industry veteran literally called it the best measured sheet charge data he has ever seen. No joke.
But okay, here's exactly why that tiny $11,000 revenue number exists. Getting a major semiconductor manufacturer to actually adopt a brand new core technology, yeah, that is not an overnight sale, not even close. It's an incredibly complex multi-step engineering evaluation process. First, it kicks off with engineering planning, all under super strict NDAs, just to figure out if integrating this tech is even physically possible. And then that's followed by a really rigorous setup phase for the actual MST integration. We are talking months, sometimes years here. Management fully expects it might take 2 to 3 months just to process the current wafers they have, and getting the full evaluation results back could easily take another 6 months.
Which brings us to Act 2, the harsh financial reality.
Now, what's really interesting about this is how it completely contrasts with those lab successes. Here comes the absolute gut punch. While scraping by with just $11,000 in top-line revenue, Atomera posted a massive net loss of $6.1 million for the first quarter of 2026 alone. To put that into perspective, that equates to a 17-cent loss per share in a single 3-month window. And the thing is, that cash burn, it's accelerating year over year. First quarter operating expenses jumped from $5.5 million back in 2025 all the way up to $6.2 million in 2026. Management was pretty clear that this jump is heavily driven by the massive costs of keeping that cutting-edge R&D going. Plus, they're trying to expand their sales and marketing infrastructure so they can actually land these big commercial deals.
So this brings us right back around to that ticking clock metaphor. Look, cutting-edge R&D costs an absolute fortune. During Q1 alone, they literally burned through $4.6 million in cash just for operating activities. When you've got a company burning cash at that kind of wild rate while bringing in almost zero money, it creates this massive immediate risk. It means management is eventually going to be forced to sell off more shares just to keep the lights on and keep the labs running.
All right, Act 3, buying time with equity. Because you might be wondering, how on earth does a pre-revenue tech company actually survive this kind of intense burn rate? Well, they have to tap right into the public markets.
So in the first quarter, Atomera managed to secure a really critical financial lifeline. They successfully raised over $26 million to bolster their balance sheet, which is huge. The vast majority of that, we're talking $23.6 million in net proceeds, came from a registered direct offering of 5 million shares, priced right at $5 each. And the remaining $3.1 million, that came from selling about 1.3 million shares earlier in the quarter.
Now, the crucial point here is understanding exactly how they got that secondary chunk of change.
They use what's called an ATM, or at-the-market offering. Basically, this is a method that lets a company sell brand new shares directly into the open market over a period of time, rather than all at once. It's a super flexible way to raise necessary funding right when you need it. But, as you can probably guess, it absolutely comes at a cost. Creating those new shares directly dilutes the value of the shares that existing investors already hold. It makes a bigger pie, but it slices it much thinner.
Atomera's CFO, Frank Laurencio, was actually incredibly candid about this whole strategy on the recent earnings call. He pointed out that given all the geopolitical uncertainty and wild market volatility early in the year, locking in that $5 price point gave them some much-needed breathing room. The ultimate goal was just to secure the cash so their team can focus purely on those highly technical commercial outcomes, without having to stress out over the day-to-day stock price movements. And, well, thanks to this capital raise, they now have over $41 million in cash and short-term investments. That officially extends their runway for at least the next 24 months.
Which sets us up for Act 4, 3 future scenarios.
So, with their financial runway extended for the next 2 years, we finally arrive at the climax of this explainer. And this brilliantly illustrates the 3 clear paths forward that analysts see for this company. First, you've got the base case. There's about a 55% probability here that the company just keeps grinding through these long evaluations, eventually has to raise even more cash, and lives to fight another day. Then there's the bull case. This is the wildcard dream scenario, right? They finally secure a massive licensing deal with a giant like TSMC or Intel, and boom, the stock skyrockets. But you absolutely cannot ignore the bear case. It is high risk. If this incredibly complex tech ultimately fails to commercialize and that nice extended cash runway dries up, the stock is going to get absolutely crushed.
So, what does this all mean for us? It all comes down to the ultimate question you should be taking away from this analysis today. In this incredibly high-stakes race against time, is Atomera's revolutionary tech going to cross the finish line and actually achieve commercialization before the cash completely runs out? Let me ask you, are we looking at the literal future of semiconductor technology here, or just a slowly sinking ship? It's definitely something to think about. Thanks so much for joining me on this explainer, and I'll catch you next time.